Hey, it's Mike Amber at FlipNerd.com. Welcome back for another exciting expert interview where I interview successful real estate investing experts and entrepreneurs in our industry. Before we get started with today's guest, which is a very special guest for me, a good friend of mine, I want to make just a couple quick notes real fast here. First, we just hit 10,000 members on FlipNerd.com and have nearly 500 wholesale deals active on the site right now. And given that we just launched 4 months ago, we're super excited about that. We actually have some really awesome things coming up over the next couple months. So if you're listening to the show, if you listen to the show regularly and somehow you're not a member of FlipNerd.com, please go on over to FlipNerd.com and register. It literally takes about 60 seconds to join. And we'll be announcing all the great new features that are coming as they come about. Secondly, we just opened up the sales for the REI Power Summit. It's reipowersummit.com. It's going to be one of the largest real estate investing events ever. It's 100% virtual and online, so no need to travel. You can join from wherever you are. And in fact, we give you access to it for 12 months. So if you have a speaker that you couldn't listen to as they rolled out, you'll have access to it for up to 12 months after the event. We have over 50 speakers committed so far, some of the biggest names in the industry, and you'll be able to learn, meet lenders and lots of other service providers, attend workshops on rehabbing, wholesaling, how to manage virtual assistants, and much more. So check it out. That's at reipowersummit.com. So for today's show, I'm joined by Scott Belsley. He's a man that I've known for a long time. We were just trying to figure that out. I think it's been 10 years or more. Actually, well before I was in the real estate investing industry. He was our tax advisor and CPA when my wife and I were corporate folk. And then when we got into real estate investing, it was a natural fit to just stick with Scott. So very few of you listening to today's show have probably ever even heard of Scott, but he's achieved what almost everyone listening to the show will find enviable for sure. Scott's really his trade is, as I mentioned, a CPA and a tax advisor, and he owned a firm for that for many years. But since the late 70s, he's built a rental portfolio that consists of over 600 single-family houses and over 1,500 apartments, so over 2,000 doors, mostly in the Dallas and the surrounding area. So Scott has quietly built a business that, to say the least, is very impressive. He's been a mentor to me and my wife for many years, and we're excited to have him on the show today, finally. We've been talking about it for a long time. So today we're going to talk about Scott's investing philosophy. He has a unique approach to a lot of the things that he does, and he's going to share with us from buying properties to managing in different markets, rental property operations, financing, a number of things really around the rental property space. So again, very excited to have Scott with us today. Before we get started though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days with rates starting as low as 9%. For more information, call 888-296-1697 or visit RealtyMogul.com/flipnerd. B2R Finance makes loans tailored specifically for rental investors. They can help you unlock equity from existing properties so you can get cash out to grow your rental portfolio. That's huge, and it opens up lots of opportunities previously not available to rental investors. Need a rental loan? Call 855-819-4412 or visit b2rfinance.com. Virtual Staff Now is your source for done-for-you virtual assistants that specialize in helping you run your real estate investing business. They recruit, manage, and train VAs for you so you can focus on growing your business. Visit virtualstaffnow.com to learn more. We'd also like to thank Colony American Finance, National Real Estate Insurance Group, and Mid-Atlantic IRA. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Scott, welcome to the show.
Good to be here.
Yeah, so glad to have you. So it's interesting. If you're like I said, I've had nearly 250 guests on the show, and very few of them I know as well as I know you. A lot of people have become friends of mine, or maybe we knew each other, running some of the same circles. But you're the first person that I've had on that I've known for quite as long as I have, and that's been so influential to my life and my businesses. So thanks for being here, my friend.
You're welcome.
Yeah. So Scott, before we get started, why don't you tell us a little bit about your background and kind of how you got into real estate investing?
I when I went to college, I was very interested. I had an opportunity to take a course under Henry S. Miller, who was a large local real estate investor at the time. This is the late '60s, early '70s, and I was fascinated with what he did. And it took a little while, but 5 years later, I was able to use some of the items that he suggested I should do and bought my first property. And it was a 6-unit apartment building on Cole Avenue. It is now where West Village is, anybody that's familiar with the Dallas area.
Pretty hot area.
Yes, it is.
Yeah.
And I bought the place, fixed it up, sold it a year later, made $10,000. This is back in '76 and '77. I said, this is the business to be in. And so I started buying and selling. And then by the late '80s, the market changed to a down market, and a very heavy down market, and I had to turn to become an operator. And since then, that's been my specialty, is management. And I buy properties, whether it's houses or small apartment buildings. I fix them up, and I operate them for a long period of time.
Yep.
Uh, and I generally will buy C-class properties. I don't like D's. I definitely don't like A's, maybe a low B, because that level has, in my opinion, the greatest return on investment for the management effort.
Sure, sure. Let's come back to that, Scott. We'll talk about the different classes, and because it's interesting because you were very influential in us changing gears at one point. I don't know if you even realize that. Well, of course you do because now you manage our rentals. So, but you were a CPA and you were in the tax business. Was that was before you started real estate investing, or did which one caused the other?
Well, it was interesting. I also, when I got out of college, I worked for one of the big national CPA firms, and then shortly after that, I went to work for a division of Lincoln Properties.
Okay.
And I had exposure on real estate from a different attribute. And I saw how those people did so well, and I said, if they can do it, I can do it. So
Yeah.
I bought my first property while I still work for a division of Lincoln Properties.
Yeah, Lincoln Properties, for those that don't know, is a huge multifamily developer, right?
And 3 years later, I started my own practice. So yes, I started in real estate a little bit before I started my accounting practice.
Yeah, and my guess is, of course, from seeing them and then from your accounting practice and your tax knowledge, you saw that as a huge way to kind of shelter you from the tax man and build long-term wealth. I assume that was the appeal.
Yes.
Yeah. So let's kind of dive into this was like in the 70s. So you bought your first property. Say that year again.
1976.
1976. So Scott, I was 2 years old then. So
the rents for a 2-bedroom were $175 to $200 a month.
Oh wow.
Bills paid.
Yeah, that's awesome. So let's talk about one of the things that I want to get into at some point here is because we were talking for a while before the show today about different market cycles, and there are a lot of people that are in this business, me included. I've been through, we started in the down cycle in 2008, and we had never hit a market like what we're seeing right now until this time. This is my first time in this kind of upcycle, and you feel the pinch of that. You kind of see what's going on. But I know in talks with you many times that you start to just develop a strategy of when this happens, this is what I'm going to do, because it tends to cycle back and forth. So you've seen this market before, right?
Yes, I have.
Yeah. Talk about that kind of generally, just with real estate investors, and maybe give a little guidance about how, for a lot of real estate investors, they tend to get in for a short period of time, and maybe they get hurt or maybe they don't, but they're not around long enough to see lots of different cycles and start to behave differently and anticipate things. But kind of talk about the importance of that if you're going to be in this business for a long time.
I was a different type of businessman before the first really bad cycle. and I was not aware of the depth of a recession and the need for liquidity and to really watch your operations. And in the late 80s, we had probably the biggest crash locally that I've seen in my lifetime. Uh, and I saw values in some parts of town drop by more than 50%. And it wiped out a lot of people.
Yeah.
And so the thing about a good market is enjoy it, but it's not going to be there forever. There is going to be a day when the market changes. So my advice to people is don't overpay, because I saw in 3 different occasions people overpaying, and then the market changes and they can't even sell the property for what they owe on it.
Right.
And as a result, we have foreclosures, we have bankruptcies, and in bad times, it's a good time to buy.
Right.
But you need to have liquidity and finance money available.
Yep.
And generally speaking, in bad times, there's a lot of money that's not available.
Right.
But the big money is made when you buy. And in bad times, that's when the opportunities are so much greater than they are today.
Sure. And I know when I came in 2008, so aside from a bunch of people thinking that we were crazy, some of those same people now say, well, yeah, you got in at the right time. And we didn't know that. It's not like we planned it. It was just coincidence that kind of happened. But we didn't have, a lot of the bad habits that people had at that point. I won't say we haven't picked up some bad habits along the way, but we didn't know what we didn't know, so we stayed really conservative. And I know a lot of folks during that time, kind of echoing exactly what you just said, they had access to capital, but it was usually 1 or 2 sources, and it was easy for them to lose access to that. And I know we were talking previously about how you're spending a lot of time now developing those financing relationships wide and broad, so that in the event or when the time comes when some of those start to go away, you have some relationships that will inevitably stay in place. So can you talk a little bit about kind of the importance of building those relationships and doing it in anticipation of what you might need in the future?
Well, you've always got to look ahead, especially to a different market. And while you're in a good market like you are today, it is important that you establish multiple financial relationships. Mm-hmm. Get to know the banker. Get to know the mortgage company. Do some deals with these people. Build up the credibility, because in bad times, you're going to need them, and you're not going to be able to keep them all. And I generally have about 10 to 12 financing sources I use today. Mm. It's gone up over the years, and in the next bus, probably half of them will not be available.
Yeah.
But this is the time to build your financing sources, get your credibility with people, and get your financing straight.
Yeah. And I know, again, even when we came in, there were plenty of banks that, they would say, well, real estate? No, that's evil. We don't finance that anymore. Or they would say, well, that person's not here anymore. Whoever the primary person that dealt with investors is not here anymore. And just, meeting with you fairly regularly, I know you opened up a number of doors for us. And there were people that, they maybe cut way back on what they were doing. But for guys like you still had relationships with them because you'd spent all that time building that, previously.
That helped a lot. And some of my relationships are 20 years old.
Yeah. Yeah.
And unfortunately, you have a relationship with the bank. Sometimes they merge. They have a different philosophy. In a few cases, the banks went under, and so you lost that relationship. That's why it's good to keep multiple relationships.
Right.
You can only finance a certain amount with a non-bank. Local banks are the key for what most investors are going to need.
Yeah. Maybe you could take a minute and just kind of share some advice because I know that you shared that with me previously, and the banks that I work with now are local banks that are here in my market. But just share how to kind of get those inroads, because I think a lot of folks have a hard time getting their foot in the door.
Well, first thing I do when I meet a new banker is I tell them what I'm interested in, see if they're interested in real estate loans. About half of them really like real estate, about half of them don't. If you got one that doesn't, go on and go to the next bank. And they all like deposits.
Right.
Be sure to let them know that you would like to make a nice deposit. And the bigger the deposit, the more attractive it is for them. And then I also tell them, as over time I've been able, as I've gotten stronger financially, I've been able to ask for better terms and better and better rates. But my philosophy is I like to do a 15-year fully amortized note. 30-year amortization never pays off. Banks don't like it. They'll do 15 years. If you get it at 5 or 10 years, it's too fast. It's too big of a payment compared to your total income. And I've found quite a few financial institutions that will do a 15-year note. Most of them will only go 5 years fixed, but then they'll adjust it every 5 years, every 3 years afterwards. The key is to have that fully amortized note, because if you're in bad times and you have a balloon payment coming up and that bank doesn't want to renew your note, you're in trouble.
Right.
And that's been something I saw back in the 80s, the late 80s. Good investors that had good property had a balloon payment come due. The banks weren't in a financial position to renew the note. They lost the property. And so that's one reason I do a fully amortized note. And 15 years seems to be a good balance between cash flow and I'm kind of old-fashioned. I like to have my properties paid off at some period of time.
Yeah.
And if there is an adjustment in the rate a few years down the road, it doesn't hurt you near as much when you're on a 15-year amortization versus a 30.
Sure.
Remember, on a 30-year amortization, 5 years into it, you've only paid about 4 or 5% down on it.
Right.
But 15-year amortization, you pay 25 to 30%.
Right. Yeah, and I want to kind of echo something that you just said, because it was from advice that you gave to me that I passed on to some other folks that I mentor and coach. Was when they couldn't. It was with a bank that you helped me get my foot in the door, which I helped some other people get in the door. I don't know if you are even aware of that, but to help some other folks get their foot in the door. And it's when the market started to get better again, it was harder to get in the door because they had taken on so many new clients. And I literally just kind of gave them the same advice that you just shared with us and that you'd given me before, was to, if you can't get their attention, just go put some money in the bank there.
That's right.
And now, instead of just somebody
That'll
walking in saying, would you like me, or can I talk to somebody? Well, they're not available right now. But when you're an actual customer, they'll find a way to become available to talk to you. So, even if it doesn't go anywhere and you have to take that money back out and go put it in another bank, at least you get their attention for a period of time.
It gets their attention in a large way. The bigger the deposits, the more attention you get out of them.
Yeah. So let's talk about kind of the importance of the operations side in a bad market versus a good market. Maybe you can kind of share some differences there.
Well, you can usually get better deals in a bad market, a lot better deals than in the market you can today. But the thing is, as an operations, you got to watch the numbers. You've got to fix your property up as inexpensively as possible, but don't go so inexpensive that you're skipping important things. Right. I've learned over the years, I do all my property in one color paint. And then I'm a C class, a low B guy. Those tenants are fine. That saves me a lot of money by just doing one color paint. Learning to adjust your operations to the type of tenant you have, using a good off-white semi-gloss paint on everything. That means when somebody moves out, I can touch it up. Saves a lot of money.
Right.
I do the same thing with carpet and flooring. They all have one color. And I can buy them in quantity. And I started doing that buying things in quantity in bad times. And I could get some decent prices. And today it's paid off even more because there's more competition out there in good times, and I've got somebody new that comes in and says I can beat the price of who I was dealing with.
Right.
It's nothing better than competition.
Yeah.
I love competition.
Especially if it's bidding for your business, right?
That's right.
Yeah.
But one thing that I think is very important with any people I do business with, you gotta pay them on time.
Yeah.
And yes, I want a good price, I want good service, but I want them to have their check, on the 10th of the month without fail.
Right. Right.
That's been my personal philosophy, and I think that helps me get better prices. And you do a certain amount of volume, like Home Depot and Lowe's, you can go to the Pro Desk and you can get significant discounts off of what you're buying.
Sure.
Much less annual volume that I get even additional discounts.
Right.
Right.
Yeah,
But
in your business, you're even buying direct on a lot of stuff. I mean, you're buying
Yeah.
stuff by the pallet load or the
Yeah.
truckload in some instances, right?
we buy things like flooring by the pallet. We buy Freon by the skid, and it's amazing how much I could save by doing that. Now I'm large enough I can do that now.
Right. Yeah.
But all these, and watch your expenses, whether it's paint, whether it's doorknobs, whether it's P-traps, whether it's carpet, and do enough to get that quality tinted in there, but don't do too much.
Yeah.
I saw some people putting granite countertops in Class D properties. You don't get more rent for a granite
Right.
countertop in a Class D.
Yeah.
In an A, yes. And you got to adjust to your tenant in the way you handle your property.
Sure. Sure. Why don't you take a couple minutes, Scott, and talk about kind of different classes of property and your philosophy, kind of why you focus on the area you focus on.
Well, Class C, to me, I have the greatest returns on investment compared to the management headache. To me, a Class A tenant is a tenant that could go to a bank and probably get an unsecured loan.
Yeah.
A Class B tenant can't get the unsecured loan, but they've got good enough credit they could probably buy a house. A Class C cannot buy a house. Their credit's bad. But they may have a good job. They've been at the same job for a number of years. They need a place to live.
Right.
And I would say a Class C tenant would probably be somewhere around $10 to $15 an hour. Approximately. I'm giving you, and then a Class D tenant, to me, are people that are on government subsidy. People that have no credit, no income, or very little income, or maybe they make minimum wage. And generally speaking, a Class D tenant will have will have problems other than credit.
Right. Right. Yeah.
Could be
And the house, and just to kind of give folks some indication of the house, and an A-class property is, well above the median price point in the market. Very nice house that, aside from their creditworthiness, is probably a harder property to cash flow. Probably somebody that's going to call for a maintenance request when a light bulb is out versus, other folks. And a B is probably around the median price point, and C is kind of more of a working class neighborhood. And am I saying that about right, Scott?
Yep. I would agree with all that.
Yeah. Yeah. Now, the interesting thing about, so we're here in the Dallas market, but this kind of applies to lots of markets across the country, is in a C-class type property, they're generally not building any more of those properties, which is what helps them maintain their value as a rental property. Can you talk a little bit about kind of what's going on from a building standpoint?
Oh, yeah. There's a tremendous amount of apartments being built in the Dallas metropolitan area, but I don't know a single complex that would be below a letter A. And I'm talking about a lot of A pluses.
Yeah.
Because the cost of construction is so high and there are so many government rules, they can only build the very top end. Well, you look at my level, which is probably the tenants pay less than half the rent that a Class A tenant would pay.
Yeah.
They can't afford this. Well, people can't afford to build a Class C property. So the Class C properties are older properties, and Bs are in the middle. And in some cases, in disrepair, although we fix them up. And the Class C properties the Class C tenant is the preponderance of the people available that want to rent.
Right.
And that level is actually growing. There's demand. There's demand is greater and greater and greater, and the supply is finite and declining because some of these older properties are being torn down, and there's less and less property for these people to live in, and there's more demand for it. So what happens? Prices go up,
Right.
and they're going up exponentially greater than a class A, in my opinion.
Yeah.
And right now, I think we are having somewhat of a housing shortage coming, and I'm putting my money where I think I want to be on the right side of the equation.
Yeah, yeah, especially at that level. I mean, even a lot of the houses that we invest in, we're buying them for well below the build price. So, there are entire cities that are just rental grade houses now that you could nobody will ever build there again because they can't afford to build at that level, right?
That's true.
Yeah.
Big chunks of town are that way.
And even the builders,
Fact-
most of the builders, in the market where we're at, in markets across the country, there's a tremendous amount of new home building going on, but they don't build at the entry level point anymore. They're building at well above that because they can afford to spend some money. And of course, materials prices have gone way up as well, so they're kind of forced to go upstream.
And they also have to qualify for a loan, and that knocks the lower end of society out. Although the upper end has no trouble, and even the Class Bs can qualify.
Yeah, yeah. Well, Scott, we've talked about different properties and our different markets and things like that. Maybe talk for a couple minutes about the importance of people being able to adapt as markets change.
Well, I've been through 4 recessions, and if I didn't adapt, I wouldn't be here.
Yeah.
And in a down market, you got to watch your expenses a lot closer than in an up market. But in an up market, the problem is it's so much harder to find a property, and you may have to change your parameters of what you would in a down market versus an up market. I've had to pay more for properties. Fortunately, the rents are higher. The ratios are slimming a little bit. I'm probably buying a fourth of what I bought 3 years ago.
Right.
Because it's so hard to find the numbers. And then what's happened in this market is we're having there's a lot more people that are looking for a place to live than there was in a bad market. So you have to cater to those people, and the quality of the tenant has actually been improving. So I've found I've had to do a little better quality make ready than I would have 3-4 years ago.
Yeah.
And you got to change with the market. If it goes down, you kind of go down with it. If it goes up, you kind of go up with it. And and I just think that if you can't, and you don't want to overpay either, because if you overpay in an up market and a down market, you're going to get creamed.
Mm-hmm. Yeah.
I've seen it 4 cycles. I've seen it.
Yeah. Yeah, my guess is I know you've been raising rents pretty much across the board whenever somebody turns over. We were talking about that beforehand. But my guess is, you always meet people that have different philosophies, right? So plenty of people that their philosophy is, well, I'm going to keep the rents low so that I have less turnover, which doesn't necessarily prevent less turnover. But, if you start to figure out what that's costing you, people that have that philosophy are leaving a lot of money on the table right now.
That's right. Yeah. And eventually your expenses, property taxes and insurance are going up. With values increasing, there's a substantial increase in property tax here in Texas, which is a big expense here. And if you're not raising that rent and those property taxes are going up, you're going to get squeezed.
Yeah.
So yes, you've got to increase your rents with the market. If you've got a good tenant and they've been there a long time, raise them, but keep them a little bit below the current market.
Yeah.
And it's a balance to where keep them below the current market, but don't lose them.
Right. So Scott, did you from the beginning, so you obviously have a huge operation that allows you to manage your own properties. You actually manage my property, so my wife and I don't have to deal with that. We have other problems we have to deal with, but that's one of the things we don't have to deal with that we're very thankful for. So there's always this discussion about managing your own rentals or not. And did you manage your own rentals from day one, from the beginning? Have you always managed those or no?
With one short exception, yes.
Okay.
I did have a management company for a short period of time, and when they painted a house for 4 times what I could have painted it for, I decided to take my property back.
Okay. Yeah, I think most people that decide to switch at some point, it's something like that happens, or the turnover takes longer, or whatever it might be. But kind of we we've got just a couple minutes left here. Maybe you could take a minute or two and just talk about the importance of good property management. And for those that are out there that are managing their own, or they have a property manager, maybe just kind of share some words of wisdom on the importance of that piece in this whole puzzle.
Well, you've got to know your tenant, be able to deal with the tenant at the tenant's level. Those that are either manage your own property, there's only so many you can handle before you need somebody to help you. Be sure that you change, that if you get to a certain size, you bring somebody in to help you, but don't lose the ability to understand what the tenant wants. If they need maintenance, get the maintenance done. You've got to be on top of the rent coming in. You've got to be on top of the changes in the area. Some of the areas of town are having a tremendous renaissance. And now you have to deal with a Class B or a Class A neighbor to your Class C. Always be able to adapt and watch what's going on in your neighborhood and keep in touch.
Yeah.
If you hire a management company, be sure they keep in touch. There's a lot of them that you're just a number. Be sure. The one advantage I have when I manage property is it's in neighborhoods that I own property, so I know those neighborhoods. And I know what's going on, and I can easily adjust my management property the same way I would the property as I own.
Right,
but
right.
Understand what's going on is the key.
Yep. Awesome. Yeah, I think it's difficult because so many people that own rental properties, they truly want it to be passive. You know, that everybody throws that word around, passive. I want a passive investment. Well, you and I both know it's not passive. And I get a shot. I use this line all the time. If I say passive around my wife, Lindsay, you know, I get a sharp elbow because it's not, even though somebody else is managing, we still deal with tax issues and insurance issues and all those things. So it's not passive, but it could be definitely a great vehicle for building wealth.
It's a tremendous vehicle for building wealth.
Yeah, yeah. Well, Scott, thanks for joining us today. I'm so glad to see you here in this interview, my friend.
Thank you for having me.
Awesome. I look forward to talking to you again soon.
You have a good day.
All right, bye-bye. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to FlipNerd.com.